Quick heads up before we start. This isn't financial advice, just breaking down how the system actually works so you can make your own calls. Let's get into it. Ever feel like your paycheck is losing a race it never signed up for? Groceries cost more. Gas costs more. Rent costs more. But your paycheck? Same number it was 2 years ago, maybe a small bump if you're lucky. Here's the thing. It's not just you, and it's not bad luck. There's a machine running in the background of the entire U.S. economy that's quietly making every dollar in your pocket worth a little less every single year. It's not a conspiracy theory. It's not hidden. It's literally the Federal Reserve's job description. Today we're breaking down the central bank's playbook, why they print money, why they call it something else so it sounds less sketchy, the what printing money actually means. So first, what does printing money even mean in 2026? Nobody's literally running a physical printing press anymore. It's mostly digital. The Fed basically adds numbers to a spreadsheet and uses that new money to buy government debt, which pushes cash into the banking system. Same effect, way less paper. Here's the analogy that makes it click. Imagine a classroom of 30 kids. Every kid has $10. That's the whole economy. $300 total, and prices for candy, toys, whatever, are based on that. Now imagine the teacher walks in and hands every single kid another $1 million. Sounds amazing, right? Everybody's rich now. Except nothing actually changed. There's still the same amount of candy, same amount of toys, same amount of stuff to buy. So what happens? The kid selling candy realizes everyone's got $1 million now. So he jacks the price from $1 to $10,000. Nobody got richer. The number went up. The value stayed exactly the same. Actually, it got worse, because now you need way more dollars to buy the same candy bar. That's it. That's the whole trick. When the Fed pumps new money into the system, the amount of actual stuff, houses, food, cars, labor, doesn't change. Just the number of dollars chasing it does. And that's where inflation comes from. The why. Official story versus the sketchy reality. Okay, so why would they do that on purpose? Here's the official reason, straight from the textbook. The Fed prints money, or expands the money supply. If you want the fancy version, to keep the economy moving. Low interest rates and extra cash encourage borrowing, spending, businesses hiring. In theory, it smooths out recessions and keeps things from grinding to a halt. That's the clean, PowerPoint version. Here's the sketchier version, and honestly the more realistic one. The U.S. government spends way more money than it collects in taxes, trillions more every single year. To cover that gap, it borrows money by selling government debt. And who ends up buying a massive chunk of that debt, directly or indirectly? The Fed. So think about it like this. The government's fed up with saying no to spending, so it just keeps racking up the tab. And instead of raising taxes high enough to actually pay it off, which would make people furious, it's way easier, politically, to just print more money and let inflation quietly eat away at the value of that debt over time. It's the ultimate cheat code. If you owe someone $100,000, and you can just make more dollars appear, that debt gets easier to pay off in real terms every year. It's not illegal. It's not some hidden scheme in a locked room. It's literally built into how the system runs. But let's call it what it is. It's kicking the can down the road, and everyday people are the ones footing the bill through higher prices, not the ones who benefit from the new money first. The impact, how this kills wealth building. So here's where it hits your actual wallet. Economists call this the inflation tax, and it's honestly one of the sneakiest taxes out there because nobody ever votes on it. Nobody signs off on it. It just happens. Let's do real math. Say you've got $10,000 sitting in a regular savings account earning basically nothing, maybe 0.5% interest if the bank's being generous. Meanwhile, inflation is running around 3 to 4% a year, sometimes way higher. That means every single year, your $10,000 can buy less stuff than it could the year before, even though the number on the screen never went down. You didn't lose money. You lost buying power. And buying power is the only thing that actually matters. This is exactly why just save your money isn't the flex people think it is anymore. Sitting on cash in a bank account isn't safe. It's a slow leak. It's like filling a bucket with a hole in the bottom and wondering why it's never full. The people who get hurt worst by this are the ones doing everything right by old school standards, working hard, saving diligently, avoiding debt, while their actual purchasing power quietly bleeds out year after year. Meanwhile, people who owe money on fixed-rate loans, inflation actually helps them because they're paying back yesterday's expensive dollars with tomorrow's cheaper ones. Feels rigged because, in a lot of ways, it kind of is. Actionable takeaway: stop playing their game. Now look, I'm not here to just dump on the system and leave you angry with nowhere to put that energy. Complaining doesn't fix your bank account. So here's what you actually do about it. 1. Stop treating cash as your long-term storage of wealth. Keep enough for emergencies. 3 to 6 months of expenses, sure, but cash beyond that sitting idle is losing value every single day. It just sits there. It's not safe. It's a guaranteed slow loss. 2. Buy real assets. Historically, things like stocks, real estate, and ownership in actual businesses tend to grow with or ahead of inflation over the long run because their value is tied to real stuff. Companies, land, production, not just a number the Fed can dilute. When more dollars get printed, real assets tend to get repriced higher in dollar terms, right along with everything else. That's not a guarantee. Markets go up and down, but historically, sitting in cash has been one of the worst long-term plays you can make. 3. Build skills, not just savings. Your ability to earn, your skills, your hustle, your income streams can't get inflated away. A dollar in the bank loses value. A skill that makes you more valuable in the job market or lets you run a side hustle, that compounds. That's inflation-proof in a way cash never will be. 4. Get aggressive about killing high-interest debt. Not all debt is bad in an inflationary world, but credit card debt at 20+% interest is a different story entirely. That's the system eating you from both ends at once. The bottom line: if the game is rigged in certain ways, the move isn't to complain about the rules. It's to stop playing by the rules that hurt you. Stop parking your future in cash. Start putting your money where it actually has a shot at keeping up. Look, the Fed printing money isn't some wild conspiracy theory. It's public information. It's on their own website. It's just something most people never had explained to them in plain English. Now you know exactly what's happening to your dollar every single year, and more importantly, what to actually do about it. If you want the real truth about your wallet, no hype, no gurus, just the actual math, subscribe to Dollar Sense. New video every week. Drop a comment. What's one thing you're doing to protect your money from inflation? I read every single one. See you in the next video.